I really don't think that the sell-off in crypto is about any kind of like fundamental weakness in crypto. Weakness that we saw in November, I believe, was tied with broader flows around different assets. And so stablecoin transfer volume, while it did come off a little bit from the prior month, was still pretty healthy. Are people still using blockchains? Yes.
Welcome back to Network Spotlight. Friend of the channel, Sebastian of Aquanau, is here to tell us what's going on in the markets. Price is doing one thing, but fundamentals, have they changed? Welcome back to the show, Sebastian.
Hey, man, great to see you again.
So I want to ask you about like the fundamentals. Like, are they still intact? That's the big question that I think is on everybody's mind right now, because price is doing one thing, but is it time to panic? What's actually happening on chain?
Yeah. So kind of like we've talked about it in prior weeks, I really don't think that the sell-off in crypto is about any kind of like fundamental weakness in crypto. I think, there was a big deleveraging event that happened in October, which has left order books a little bit thin. And so we've got a little bit more volatility than we have had. But like by and large, the weakness that we saw in November, I believe, was tied with like broader flows around different assets. So here we have like Bitcoin versus the UBS speculative basket. So stocks that are involve, some crypto for sure, quantum computing, nuclear fission, that kind of stuff like that, all kind of wrapped into this basket. And you see like they sell off in tandem. Bitcoin does react more than those equities, but that's kind of to be expected too, right? Bitcoin's a little bit more of a nascent asset than some of the other ones, although its market cap is huge. It's still quite speculative in nature, I think. But like so all that to say, it was tied into like, oh, let's sell speculative assets and other kind of momentum trades, which is kind of what we saw. And then we had seen a pretty healthy rebound as well, and we could talk a bit more about that later. But back to the fundamental side, I think the biggest story this year, or in crypto in general, in my opinion, is like the stable coins. And so stablecoin transfer volume, while it did come off a little bit from the prior month, was still pretty healthy. And stablecoin monthly active addresses kind of also hanging in, near all-time highs, or like near the peaks and stuff. So to me, like the on-chain activity, like are people still using blockchains? I would say yes. Maybe some speculative fervor has come out of the prices of the assets that are tied to these blockchains, but I don't feel like we're in a recession in terms of on-chain activity, as indicated by stablecoin activity. And if you go to the next slide, it's even on relatively more nascent ecosystems in the crypto space, we see like continued upward trend where like outside of Bitcoin and ETH, which is where like the institutional focus has been so far, and now you see Solana like printing a huge new stablecoin supply in November, and almost reaching all-time highs there as well. So not really something that makes me feel super bearish on the stablecoin side. One thing there's the next chart. To me, this is like the chart of the month. The outside of price, I know everyone's going to focus on that kind of stuff, but like to see PayPal's PYUSD like continuing to push higher in a vertical way versus Athena's USTE just completely getting woodshedded in terms of supply. It's insane. That decline is massive. It's kind of telling. Like I don't know that this is like a forever kind of situation, and I really don't. I'm not trying to make this tell the story that people are leaving USDE to go into PYUSD. That's not the case, but I think it's fascinating where like you've got PayPal's kind of like neobank related stablecoin getting minted on chain, while like this more esoteric yield bearing asset in Athena falls off in terms of interest. And so I think to me that's a powerful kind of signal where it's like one narrative seems to be winning out over the other. In addition to, of course, Athena's like having a harder time given the funding rate environment, but nevertheless, I think it's interesting. And then like that's really kind of hammered home in the next slide where we saw a couple like super high profile CDPs and like looping kind of architectures kind of implode last month. Athena is certainly more institutional grade than some of these other ones, but it's nevertheless interesting to see super fast collapse that can happen in some of these treasury management type of stable assets. And I think that was something that people need to remember. Just because you say something is stable and it's stable in some market conditions, you have to really kind of look under the hood to see like, is this thing going like to be stable? I would argue that the yields that people were earning that were like, meaningfully above the risk-free rate, whether that be like, the risk-free rate, like, lending or supply rates on Aave, or the risk-free rate in the real world, there are multiples higher than that. What's what is the risk you're taking on to earn that return? And I think the charts that you see here is that's the risk. So, you got to think it's like is 15-20% worth of zero potential, and it's like, I guess it depends how long you're earning it, but uh, and then just lastly, we can kind of move on from the AQN chart pack here. Is, oh man, I know it's a typo on my slide, brutal. Is here where we've got tokenized U.S. money market securities also kind of like printing new all-time highs in the month of November, which I guess underscores this broader theme of tokenization more broadly, and for demand, and of demand for like real stable assets on chain. It's like the 15-20% might be appealing to some people who are trying to like gamble, or like you know some leverage, like leverage looping and that kind of stuff, or recursive looping. But at the end of the day, like there's like this institutional demand here, 8-10 billion or 9 billion of tokenized money markets, says like money market securities have demand on chain, and like it's kind of speaks to like a nice kind of continued trend of tokenization in the space.
Slide 16, Phantom's cash supply. What's this about?
So, uh, Phantom has launched two kind of new products recently, both of which are offered through other providers. At the moment, I can't recall exactly who the provider is that's helping Phantom access this uh, stablecoin architecture, but they have this new cash stablecoin within their kind of wallet that they've been trying to incentivize people to use in a little way, and I think that's going to increase meaningfully here in the coming kind of months and quarters. But they have their own kind of branded stablecoin, and then they also use hyperliquid builder codes to provide like in wallet perps trading, which now also has perps trading of tokenized stocks. And so, to me, I think you're seeing like in previous instances of this presentation, I've talked about EtherFi and some of the other kind of like neo banks that are using crypto rails or whatever else. And I think Phantom is one to watch in this regard, because they've got their own stablecoin. They're going to have payments in real world payments, and they've got this perps thing. It clearly is a theme and an emerging kind of meta in crypto, but I see this like as a has a lot of runway in it, regulations permitting.
So a lot of news around stable coins. Go figure, right? That some things don't change, but definitely besides the price action of what's happening in the markets, in terms of adoption, things are growing rapidly. And on that topic of adoption, there's actually something that you put out, Sebastian, that I want to kind of get your thoughts on. It was around crypto cards. You reposted this, and I guess some people are questioning the data, how accurate it is, but I think the point you're trying to make here is if you just look at the overall trend, that's kind of like the biggest message here, which is the adoption of these crypto cards, which is essentially stable coins that people are using to make regular payments, right?
Yes and no. Like it can be stable coins, or it can just be other crypto assets as well, right? So like EtherFi's kind of and others have the ability to, like, someone can have like Ethereum or staked Ethereum even, and then they can actually borrow against that balance to make payments in the real world. And so it's a way for these neobank cards to like they keep the interchange fee, and then they could actually charge additional fees on top of that to people who value that the ability to like borrow, or sorry, spend without selling their digital assets, whether that's a market timing issue, or increasingly you can do things where it's like, oh, I've got like a yield bearing volatile or stable asset that's going to like generate more income or return than the cost of borrowing. And so it's like this kind of really fascinating new development that obviously has product market fit, right? Like people want this, and it's and so yeah, I thought it was kind of funny in the comments of, so Stacey Moore has written about this a lot, and like I'd recommend people go check out her stuff anyways. It's quite good across a lot of different data spectrums. A lot of the inspiration that I get in the chart pack, will come from some of the stuff that she puts out. Not to her, I've never met her, but good work that she puts out. And so anyway, some people were like in the comments there were dunking on like this chart, saying, oh, there's double counting and whatever else, but it's the slope is the important part here, and I think like we're in early innings as far as I'm concerned.
adoption still up and to the right for sure. And then you also talked about Vanguard. This is definitely a big plus for adoption. I know that a lot of the banks are doing a complete 180. Vanguard, Bank of America, which was essentially saying we don't want anything to do with crypto when Bitcoin was sitting below 60K. And now all of a sudden, you have a lot of these large institutions, some of the most conservative institutions are, turning the corner on crypto.
Yeah, I mean, Vanguard famously, even just as much as a few months back, doubled down on their like, no, we're never going to let people access crypto on our platforms. We're like, our investors don't want that kind of stuff, and like, obviously, that's changed. So, I think that's pretty meaningful. Bank of America this week also announced that they are recommending like somewhere between 1% and 4% to portfolios, and so, I mean. The thing is it's been interesting, like even throughout all this volatility. Yes, there have been redemptions from ETFs, but like some days have been positive, and then you kind of saw this like you see this continual bid, right? People when they get their paycheck, some of them are buying crypto every time, and there's this kind of general continued bid. Various pension funds and other institutional investors have been kind of chipping away this whole time, and that's because when an institution decides they're going to go and do something, they don't just flip a switch and say, okay, we're all in on this one thing. It takes time to build a position up, right? And so, but it's very fascinating how in the current tape, when you've got a lot of like crypto Twitter people who are like freaking out about price, other people are coming in, and I think and there's more and more platforms in the world's largest economy, the U.S., that are allowing and in some cases even encouraging the use of these assets. Surprisingly, though, and this is where the kind of tweet you're on right there is like 2/3 of institutional investment mandates are still at zero, and so that's really fascinating. I think the the institutional portfolios kind of have like someone at the helm or whatever else, and sometimes those folks just will say no, like kind of like the Vanguard thing. I don't want to own it. I don't have to own it. In the case of like Vanguard or other like retail driven platforms, if they're getting pushed from their like asset providers or like from their constituents, then they're gonna do what they want and let it happen. But if you're running an institutional portfolio, you're kind of just mostly against your benchmark. Maybe you could have beat it if you had Bitcoin or not, but you can just say like I don't want to own it, and like that's kind of what it is. So I think for some of that institutional stuff, it'll either be return driven, where like a crypto goes on another run and like really kind of like makes people be like, oh, geez, why didn't you own Bitcoin? You would have like dominated this year. That like obviously it's not the case so far, so that hasn't really been much of a pressure. But I think more and more you'll probably start to see people at the top of these or these like lead portfolio managers maybe be replaced by folks who don't have the same kind of predisposition towards like I hate crypto so it's never coming into my portfolio, or you end up having some performance driven reasons for people to own it. We'll see, but it is pretty fascinating how like the retail platforms are like saying, okay, retail clients, you're allowed to will allow you to or even encourage you to own some of this, versus the professional money managers are still largely at zero.
And the fact that the 67% of the, have that zero allocation, I mean, to me, I think that's seems pretty bullish, right? The sky's up from here. So it's great news for sure. And also on the banking side of things, I saw this that you posted. Europe's new bank led stablecoin, like 10 different banks in Europe, right? They're all teaming up for this. But this is not necessarily CBDC, is it?
No, it's a private coin, and I don't really think that they're like necessarily trying to compete with like the tethers or the USDCs of the world either. I think what they're trying to do is like maintain a level of relevance for the euro as it relates to on-chain activity. So they're like, and I think it's like they're starting to see, okay, wait, if the US pushes full out into this space and they're like being able to move money around, like it's easier to move a dollar around the world than it is to move the euro around the world. There's that's a threat to like an additional threat to euro use case in the global economy. And so I think uh, the Europe is I mean, well, a lot of the world is kind of handcuffed with bureaucracy and that kind of stuff. Europe in particular, they've got different countries and lots of different folks kind of weighing in on stuff like that. There's different regulatory schemes in the US, but like if like Congress, the Senate, and the SEC kind of say one thing, like there might be some kind of pushback along the ways, but like most people will just fall in line with that. And that doesn't like Europe's trickier with respect to its architecture that way. So it is kind of neat to see a bit of a private sector push here where the banks are saying, okay, well, like, look, we'll wait for like the bureaucracies at the top to figure out what they want to do with this. We're going to go and try to do something. Really fascinating is that BNP Paribas is actually on is part of like a U.S. bank-led consortium as well as on the European side. So we'll see what that means exactly. Maybe kind of being able to share on the one hand would be beneficial, or I'm not sure, but it's kind of fascinating to see them kind of sit on both. But at the end of the day, I think if the banks are allowed to provide like European trading venues with like this new stable asset as like a trading pair, which they're going to start with, and then they're going to move into payments. I think that creates a lot of value. If you see a world where maybe in the not too distant future you can take your stable coins and convert them into your bank account and then use your debit card for that, like which is kind of what a lot of people can do already with the EtherFi card, but you know what I mean, like ignoring the credit component of that and just say it's your debit card or whatever else, which are more commonly used in Europe in particular. I think that can make the on-chain world a bit more relevant for the euro, and then you might end up having some additional kind of like network effects there. But one of the things that I'm not worried about, I just didn't like see a ton about this, is like banks have a tendency to do things within their own silos. How open will this initiative be? One of the beautiful parts about stable coins, I think, is like if they're programmatic money or programmable money. That goes away if it's in a box or it's like it's kind of siloed off or whatever else. So people won't be incentivized to like build on it. If it's very easy for people to do that, then I think they will, right? Why would you not allow Kibalis, which is the name of this asset, to be part of your infrastructure unless it's like hard to do or impossible to do? So, I mean, on the one hand, banks fantastic for compliance and they have credibility with more credibility with more people than crypto does. So that'll help adoption, I think, as long as they don't make this a field experiment by being overly bureaucratic, because there's 10 banks here, so that might be tricky to get people to move together, and then b like maintain like an open architecture and just kind of know what it is that they want to do. But it's certainly cool to see anyways, and constructive directionally.
Yeah. So all of this is happening long term. Let's kind of touch on some of the things that are happening in the short term. So you mentioned that Goldman Sachs, John Marshall reads the option market tea leaves for us as we head into a pivotal week ahead. I was trying to read through this chart and it sounds like, well, what it's saying is because the likelihood of us getting a rate cut, the markets seem to be a little bit more predictable, less volatility. Am I reading it right between the lines?
Yeah, so it's just like we're coming out of a period like in October, November, or where volatility was pretty high, like relative to like very recent histories. So I guess the idea here is that things have stabilized. The anticipation for big moves as it relates to like the options market, like implied volatilities and stuff like that, are have kind of moderated quite a bit. That's interesting. Like next week we have a pretty important Fed rate cut decision. Like the markets for interest rates suggest that this is like almost like very likely to be a cut. And the rhetoric recently has kind of alluded to that as well as some of the data. So it's like, okay, like maybe that's the case, and maybe that's the right thing, is that the options markets are expecting kind of a ho hum kind of response to that. We get a cut, okay, cool, and then we resume into year end. I don't think like what a lot of people are saying is like you know when you're a portfolio manager. If let's say you locked in your gains in November, then in December, you're not trying to take a ton of new risk or whatever else. And it seems weird that you would do this on the calendar, but for whatever reason, this tends to be how a lot of like institutional money kind of gets reallocated. Is like, okay, 2026, now what are we going to do? So January's tend to be pretty volatile months, but like in December, we might kind of have this like kind of ho hum kind of market, which is what the John Marshall is kind of alluding to here. So like institutional positioning is kind of drifting lower. Markets are kind of moving a little bit higher. It's like, okay, kind of boring. And then single stock options, you're seeing like retail buying less single stock options, which is you know, interesting anyways. Like could be maybe most people are, you know, not trying to trade zero data expiry options over the holidays. They're busy like hanging out with their friends and family or whatever it might be. So that's interesting, and actually that allows a lot of like hedge funds to feel a little bit more comfortable putting on some shorts. So that's interesting, but nevertheless, you know, they're not like nothing's expecting like huge moves here. And then in credit,
Question for you, Sebastian. Sorry to interrupt. When you say single stock option volumes, does that impact for anybody that's doing options trading on, say, SPX?
there would be like some effect into XPX in the sense that like it is constituents are single stocks, so there's potential for like, you know, some cooling in the constituents to have an impact on SPX, but not like a direct relationship. The comment here is really more about the single stocks. You know, I'd have to have a look and see what the index options are doing, but I would think it's probably the same if institutional investors are kind of pulling back a little bit in activity, that'd be similar there, but I'm speculating.
Sounds good. And then what about this credit markets graph?
Yeah, so just like, you know, like there had been some flare ups, you know, kind of, you know, in November and elsewhere, you know, whether that's like in SPY or credit and that kind of stuff like that, but it's kind of come back in. So it's like, okay, like, you know, that was a little bit of like some people were freaking out for a bit in November with respect to like some of the moves and fundraising announcements, but seems like that's all come back in now. So it's like, okay, well, we're not super worried in that kind of stuff. So, you know, vol is cheap. And the next one here kind of just shows like different quartiles. And so like, or interquartile, like, yeah, like quartiles and then the interquartile ranges. And so like the dark blue, like horizontal lines here are like where we are. And so you see like in most of the asset classes, you're like towards the low end or below the interquartile ranges. And so it's like, okay, like pretty cheap relative to where you are. And then where it's higher is in the Nikkei, Japan, which we'll talk about in a second, gold, which, you know, continues to charge higher. And then the equity factor vol, which is largely going to be impacted by like momentum, which had a crazy November, right? So there you have like, you know, the three areas of the market where you have kind of higher volatility is like where we're expecting it, but everywhere else is pretty chill. Even the volatility and the volatility of volatility are low, so or like, you know, kind of in line kind of thing. And so, you know, it's pretty balanced overall. So it's like the options market institutionally and retail wise is kind of saying like, meh, no big deal, which I think is interesting. You know, especially as we do kind of head towards this like this asymmetric risk kind of moment with the Fed. Like if they, you know, we'll see what ends up happening. Probably they'll do what they can to kind of assuage markets, given the, you know, the that's kind of what they do. But we'll see. It's kind of an interesting kind of finding, nevertheless.
Absolutely. And then just more stuff on the short term. I mean, overall, it sounds like 2026, although short term things to be a little bit more predictable, there seems to be some volatility on the horizon in 2026.
Yeah. Actually, I think it might be better if we go to the last tweet. We go to that one first. I'll talk a little bit more about some short term, and then we can talk about that one little tweet there about 2026 outlook. So when we were looking at those last set of charts, we saw that like implied volatility was still high in Japan, gold, and factor vol. We'll focus less on factor vol here, but like Japan, the yields there continue to go higher, which implies that the bonds are getting sold. It's kind of creates a lot of like strain on the broader kind of crypto liquidity space, um, where or not crypto liquidity, broader like macroeconomic liquidity space, where it's like, so if now Japan is like got a lot of like kind of monetary fiscal kind of like problems, their bond and asset markets were typically in a low rate in like kind of like regime. Sorry, they were like in a regime of like accommodated monetary policy, low rates, all that kind of stuff. And so a lot of liquidity around the world had kind of like geared itself around that. And then now it's like, okay, well, hold on a second. Like if these Japan rates are going higher, that makes certain trades and certain parts of the way that the world is working a little bit less good, or like erode certain trades. So they have to back out of that kind of stuff, which is, you know, what you're seeing with some of the bonds and that kind of thing. It's this yen carry trade that everyone talks about. And then, of course, is like they bring in assets from overseas back into Japan because the rates are higher. Then that kind of creates this a bit of a bubble, or not a bubble, a bit of like a self-reinforcing cycle. So all that to say, the happenings in Japan have equity vol there high on a relative basis, as well as having kind of some ripple effects into the markets, which we'll talk about now. So, this is an interesting chart here. We've got NASDAQ and Bitcoin. Bitcoin sort of trading like a tech stock this year, and then in October had this kind of liquidity crisis and then has really kind of pulled back since then. Had a little bit of a bounce, but like if you look at the NASDAQ, still pretty near all-time highs. And while, Bitcoin's like, still quite substantially down. Higher beta asset, so maybe that makes sense, but like the rebound wasn't as strong as the downside. So there's like, okay, what's going on there? So that's an interesting gap. And then if you scroll down, you'll see like, okay, well, the NASDAQ is like, really great companies. It's got a quality bias. So it's like, like maybe you'd expect people to kind of go back into that one before Bitcoin. And so you see that like Bitcoin has traded, kind of in line a little bit with like non-profitable tech as well. And so, you'd think, okay, so, Bitcoin maybe is like a non-profitable tech company or crypto more broadly. So you see like, okay, that happened. It was like, above for a long time. Then, the non-profitable tech kind of had a bit of a more of a run while Bitcoin kind of traded sideways. They both kind of pull back hard. But the non-profitable tech baskets kind of retraced like call it half of its pullback versus Bitcoin, which is still kind of trading near the lows. It's like, oh, that's another really kind of interesting gap. It's like, well, what's going on there? And then I think the kind of going back to that Japan thing, you see here the white line is the if you scroll down a bit, Mikhail, the white line is the inverted Japanese 10-year yield. So as it goes down, that's actually implying that yields are going up or Japanese bonds are being sold. So as that is kind of going lower, you see Bitcoin, or the yields are really going higher, but the inverted is going lower. You see Bitcoin tracing that too. This is not a forever, like if you chart the Japanese yields versus Bitcoin over longer track periods, it's not going to like match up like this, but it is like this is the kind of one of the important narratives in the space right now is like liquidity is being drained from the like from a number of different factors, like both like the government shutdown and then other other things like in the global markets like this unwind of the Japanese carry trade and then other kind of like impacts as it relates to like people that the Japanese repatriating capital and so on. So when you see this this is to me interesting where it's like, okay, so maybe, right, we don't know, but like the story goes that like this liquidity kind of crunch that's a result of Japanese yields going up is pulling down Bitcoin, which is like this liquidity driven instrument. That's very interesting. So for a long time, Bitcoin had traded like the stock index, the technology stock index, or like non-profitable tech. They seem to be shrugging off this Japanese liquidity issue. So or maybe they're getting a bid as like a bit of a safe haven in that all that. It's hard to say, but nevertheless, I think like the gap is noticeable between tech and crypto, and then maybe like tech and these yields. So who's right? Is it equity PMs that are saying like so that's a nothing burger, who cares? Or are they like more on like holiday mode of like, hey, well, we locked in our profits for the year. We're kind of like we've reduced exposure a little bit, or we feel comfortable with where our positioning is today, so we're just going to ride this out. And then you have kind of like normal, kind of regular buying activity, and then hedging activity that moves things higher. Or are the Bitcoin or like the macro markets kind of sniffing something out that stocks are going to react to soon? We'll see. We're at the Fed next week. That's probably the most important thing in the short term. But yeah, just some interesting happenings there.
Absolutely. And I'm going to include all this in the links down below, Sebastian. So X is where we can find you. Then also you put out the monthly report for Aqua. We'll include the links in that description as well. And for those that are watching, subscribe to the channel, like the video, give Sebastian a follow. He puts out great content as always. And Sebastian, we'll talk again next week.
Looking forward to it, man. Thanks.
If you're a founder or operator in Web3 and want to connect with others like you, head on over to networkspotlight.io and apply to become a member. See you on the inside.